All right, so now we're going to do 11 through 20 on the extra overs and unders. So let's start with number 11. Alpha purchased merchandise on credit with the terms FOB destination. As of December 31st, the merchandise had not been received by Alpha. Alpha recorded the purchase and included that merchandise in ending inventory. So with the terms FOB destination, they don't record anything until it reaches its destination, until they get it. But they hadn't received it yet, which means they shouldn't have done anything. But they recorded the purchase and they included it in ending inventory. So here, the recording of the purchase was a debit to purchases and a credit to accounts payable. The credit to purchases would have decreased our net income because it's an expense, and the credit to accounts payable would have increased our liabilities. So when they also included it in their inventory, they didn't really do a journal entry. They just included it in their inventory, which would have increased their assets. So this problem's a little different, and we also need to look at the COGS account. We're not doing a journal entry with it, but we want to see how these accounts have affected our COGS. So looking at our COGS formula, we have beginning inventory plus our purchases minus our ending inventory equals our COGS. So we can see that beginning inventory has a positive effect on COGS. Purchases has a positive effect on COGS. But ending inventory, because we subtract it, has a negative effect. So looking back at what they recorded, they increased their purchases, which would have increased COGS. They also increased their ending inventory, though, which would have decreased COGS by the same amount. So by increasing it with a positive effect and increasing it with a negative effect, there would have been no effect on COGS, which translates to this with COGS and purchases having no effect on net income. So now for assets, our inventory was increased when it shouldn't have been. So our assets are going to be overstated. And with accounts payable being increased, that increased our liability when it shouldn't have. So liabilities are overstated. And since, purchases decrease our net income, our inventory, because it's included in COGS, cancels this out and there's no effect on net income. Because purchases increase it, ending inventory is increased, but it has a negative effect. So it cancels it out and there's no effect on net income. Okay. Number 12, Alpha should have recorded the purchase of supplies on credit, but didn't. As a result, no AGE was recorded at the end of the year for the amount of those supplies used. So here, only some of the supplies have been used. So we're going to use numbers to make sure that we know how much it's being increased and how much it's being decreased. So they never recorded the initial purchase of supplies, which was a debit to supplies for 1,000, which would have increased our assets, and a credit to accounts payable for 1,000, which increases our liabilities. They also did not record the adjusting journal entry at the end of the year for the amount that they did use, which would have been a debit to supplies expense for 800. So it's an expense, so it lowers our net income. And the credit to supplies, which would have lowered our assets. So let's look at the answer. Supplies should have been increased by 1,000, but decreased by 800. So net still should have been increased by 200, which means our assets are going to be understated. And for liabilities, our liabilities were never increased by that 1,000. So our liabilities are going to be understated. And then the expense was never recorded. The net income never got lower. So our net income is going to be overstated. Number 13, Alpha failed to record the prepayment of 1 year rent paid. They also failed to record an AGE at the end of the year when there was still 9 months of time remaining on the lease. So they never recorded the initial prepayment. So that's a debit to prepaid rent, which would have increased our assets, and a credit to cash because they prepaid it, right? Which would have decreased our assets. But at the end of the year, there is 9 months left remaining on the lease, which means we need to expense 3 months of that prepaid rent. So we're going to assume that it's $1,000 a month. So that initial one's going to be $12,000. And if we have used 3 months of it, we need to expense 3 months of that rent, so $3,000. We're going to debit rent expense, which is going to lower our net income. And we're going to credit that prepaid rent because we use it now. It's not prepaid anymore, which is going to lower our assets. So assets were not increased and decreased by the same amount. So those cancel each other out, but it was also not decreased by that 3,000. So assets are going to be overstated because of this. These cancel each other out, but still should have been decreased by that 3,000. So we have an overstatement in assets. Liabilities, none of these accounts affect our liabilities, so there's going to be no effect on our liabilities. But now we never recorded this expense. Net income is never lowered, so our net income is going to be overstated. Number 14, Alpha sold merchandise to Beta on credit with the terms FOB shipping point. As of December 31st, the merchandise had not been received by Beta. They did not record the sale, and they counted it in ending inventory. So just because they haven't received it yet doesn't mean anything because it's FOB shipping point. They shipped it, so they can record it. So they did not record the sale and they counted it in their ending inventory. They should have recorded the sale because they shipped it with the terms FOB shipping point. They also should have taken it out of their ending inventory. So that would have been two different entries. Would have been a debit to AR for 1,000 and a credit to sales revenue for 1,000. And we're just making up numbers here. That would have been an increase in assets, and the sales revenue would have been an increase in net income. And now to take it out of their inventory and to record the COGS of it, they're going to credit COGS for $750 because the amount that we sell it for is not going to be the amount that it costs us to make. And that COGS is going to lower our net income, and we need to credit inventory, take it out of our inventory, and we need to lower our asset by that amount. So for assets, we have that it should have been increased by 1,000, but decreased by 750. So net should have been increased by 250 still. So assets are going to be understated. And for liabilities, none of these accounts affect our liabilities, so nothing happens to our liabilities. For net income, should have been increased by 1,000, but decreased by 750. So net still should have been increased by 250, which means our net income is still going to be understated. All right, number 15. Alpha paid cash to satisfy an account payable, but recorded it as a dividend paid to shareholders. The declaration of the dividend was previously recorded. So what they did was a debit to dividends payable, which would have decreased their liabilities, and a credit to cash would have decreased their assets. What they should have done was a debit to accounts payable, which also would have decreased their liabilities, and a credit to cash, which would have decreased their assets. So here, our liabilities were decreased the right way. As you can see here, it was just the wrong payable account, and cash was credited, which is correct. So since we're looking at the total liabilities, they were decreased in the right amount, but not just in the right account. So there's going to be no effect on assets because that was correct. Liabilities were decreased correctly, so there's also going to be no effect. It was just the wrong account. And none of these accounts affect our net income, so we're also going to have no effect on our net income. Number 16, Alpha made a cash sale but recorded it as a loan from a bank. So they recorded it as if they got money from a bank. So they debited cash, which would have increased their assets, and they credited loans payable, which did increase their liabilities. What they should have done, because they had a cash sale, they should have debited cash, which they did, but they should have done a credit to sales revenue, which would have increased their net income. So here, assets were done correctly, so there's going to be no effect on our assets. but liabilities were increased when they should not have been. So our liabilities are going to be overstated. And here they never recorded the sales revenue, which would have increased our net income. So sales revenue increases our net income, so our net income is going to be understated. All right, number 17. Alpha erroneously recorded an AGE for interest on a note receivable instead of the correct AGE for interest on a note payable. Interest won't be paid by Alpha until next year. So what they did was they recorded it as a receivable. So they did a debit to interest receivable, which increases our assets, and a credit to interest revenue, which increases our net income. What they should have done is they should have recorded it as a payable, an expense. So they should have done a debit to interest expense, which would have lowered our net income, and a credit to interest payable, which would have increased our liabilities. So let's look at our assets. Our assets were increased when they shouldn't have been. So our assets are going to be overstated. And for our liabilities should have been increased, but they weren't. So our liabilities are going to be understated. Now for net income, it was increased when it really should have been decreased. So it was way higher when it should have been lower. So our net income is going to be overstated. Number 18, Alpha purchased equipment on credit, but did not record it. No payments were made during the year, and no AGE was recorded for depreciation on the equipment. So since they bought it on credit and they say no payments were made during the year, which means they just never paid the cash and lowered that account payable. So here, another depreciation. So we need to kind of use numbers to make sure we're valuing everything correctly. So we forgot to do everything. So we're going to debit equipment for 1,000, which is going to increase our assets. They bought it on credit. So we're going to credit our accounts payable for 1,000, and that's going to increase our liabilities. And they also did not do depreciation at the end of the period. So we should have done a debit to depreciation expense for only 200, which is going to lower our net income. And we should have done a credit to accumulated depreciation for 200. And since that lowers our assets, it's gonna lower our assets, a contra asset. So looking at our assets, equipment should have increased our assets by 1,000, but accumulated depreciation would have decreased it by 200. So net should have been increased by 800. So our assets are going to be understated. Now for liabilities, they should have been increased. So liabilities are going to be understated. And the expense was never recorded. Our net income was never lowered. So our net income is going to be overstated. Number 19. Alpha failed to record an AGE for interest on a note receivable. Interest won't be received until next year. So they just didn't record the interest, which is a debit to interest receivable, which increases our assets, and a credit to interest revenue, which increases our net income. So for assets, they were never increased, so our assets are going to be understated. Neither of these accounts affect our liabilities, so there's going to be no effect on our liabilities. Interest revenue increases our net income, it's a revenue account, and that was never done. Our net income was never increased, so our net income is going to be understated. All right, number 20. Alpha received cash from a bank, but recorded it as a cash sale instead of a loan that must be paid next year. So they recorded it as a sale, which is a debit to cash and a credit to sales, when it should have been recorded as a debit to cash and a credit to loans payable. So the cash was correct, right? There's no effect on assets because the increase on the asset was correct. Now for liabilities, which is the credit to loans payable, our liabilities should have been increased, but they weren't. So our liabilities are going to be understated. And now sales increased our net income when they shouldn't have. And so our net income is going to be overstated. And that is 11 through 20.